Hi, hello everyone. This is Akshara Menon from pmsbazaar. A warm welcome to today's webinar. Also, I want to thank you all, for taking time to join us today. As we begin this new year, the markets are already reminding us that 2026 won't be a year of straight lines. So what looks very stable on the surface are often more complex underneath. It's just like that, India's long-term growth, looks very strong. But the near-term environment it's a bit layered with uncertainty from the global trade politics, geopolitical tensions, and currency swings, and even the market participation and shifting the capital flows. Even every factor is forming the a bit of instability in near term. Today's webinar is not about predicting the markets, which no one can. It's about understanding the market behavior, interpreting the signals beneath the headlines that we're going to see every day, and the learnings and how the seasoned fund manager navigate this without, emotionally getting connected or taken away by the short-term noise. Our discussion for the today is equity markets 2026 outlook, risk, and strategy. So in this, it's my pleasure, to welcome Mrs. Ashish Chaturmohta, MD Fund Manager of Apex PMS, JM Financials Limited. We're delighted to have you with us today, sir. But he's a chartered accountant with over 19 years of experience in the capital markets. So he's an investment professional known for his sharp analytical skills and market foresight. Ashish follows the fusion investing. It's like having everything on his plate. It includes fundamentals, technical, psychology, and market dynamics, but truly combining science and art of investing. So he has a record of spotting companies with strong business models and sustainable earnings and favorable sector tailwinds, using the technical validation to time the entry and exit points, helping to manage risk while capturing the potential upside. Over the years, he had earned multiple accolades, including India's Best Market Analyst Equity on 2011 by Z Business, and he has also been featured among the Best Analysts by Economic Times in 2014, with a strong media presence and disciplined process-driven approach. So it's great to have you on to the show, sir. Yes, sir. Go ahead with your PPT.
Thank you, Akshara, and thanks everyone for joining this webinar. So start with, we will try to first analyze what's happening, what has happened exactly in 2025. So we'll first, understand what broader markets have done, and how India has fared along apart from its counterparts. So if you look at this, the 1 year return of index was close to 10.5%. Whereas if you look at the world market, or MSCI World, it has delivered almost 20.6% return, and the emerging markets in general have delivered almost 30.6% return, where China has contributed almost 28% return. So keeping this in mind, actually India has underperformed the global markets, both the emerging market as well as the world MSCI World. But if you look at on a 5 year time frame, India has outperformed despite the underperformance which we have seen in last year. So keeping this in mind, we have performed almost 13.3% kind of returns on a 5 year basis, versus the world index generating almost 9.4, versus emerging market doing almost 1.7. So there's a clear outperformance which India has generated against the broader markets on a 5 year time frame. But the interesting part is, although the index has delivered a positive return, if you look at the BSC small cap, this index has generated a negative return of 6.6% on a 1 year basis. And if you look at the broad base market, there's a data which suggests that out of the more than 2,000 actively traded stocks, if you look at 80% stocks have given a negative return in this year. So this clearly indicates that just 20% stocks were able to beat this broader indices, clearly suggesting that the broad base rally was missing, and there was a general huge kind of advanced decline ratio, clearly suggesting that the broader markets were weak. But if you look at the small cap performance on a 3 year or a 5 year basis, they've generated close to 21-23% kind of return respectively. So in the longer term, the small caps have delivered far better than the Nifty 50 and obviously the global markets. Where the real returns came, obviously the commodities part, where gold on a 1 year basis has delivered 64% return, but on a 5 year basis it has compounded at 18% kind of compounding. And silver was outlier, so it has generated almost 148% return in last year. Now coming to the valuation parameter, if you look at our markets, so MSCI India, which used to trade at 100% premium to the emerging market, that premium has actually narrowed down to 65%. So we can say that we have become much cheaper as compared to the emerging market. In comparison to our long-term averages, where we used to trade always at a significant premium to emerging market, but that premium has narrowed down. Whereas if you look at on the MSCI World parameter versus India, so India used to trade at 24% premium to the world market, and that premium is also narrowed down to 8%. So it makes India very attractive against its against the emerging market as well as the world market from a pure relative valuation perspective. Now, if you look into the FI and DII data, clearly, if you look at FIs, except for the month of October, where they have poured in almost $1.3 billion. But if you look at the entire year to date, or maybe 1 year, this data clearly suggests that almost $16 billion kind of outflows have been seen from FIs in 2025. Obviously, due to a lot of factors. So US-India tariff-related uncertainties created a lot of concerns, which resulted into huge amount of trade deficit, and it kind of created nervousness in our markets. At the same time, Japan's interest rates have started going up, so there is a possibility of a reversal of yen carry trade, and this is leading to huge amount of global liquidity shifting, and that is also creating a lot of nervousness in the global equity markets, and particularly in India. And but what actually supported us was the domestic institutional investors, who bought almost $87 billion of equities in year 2025. But despite that, despite FIs buying significantly in this 2025, we have not seen meaningful outperformance against the global markets. And one reason for such kind of underperformance can be the IPO market. So if you look at year 2024 and year 2025 put together, almost $44 billion of IPO came in this last 2 years, and which kind of sucked a lot of these liquidity, or kind of fresh inflows which was coming from DIs, but it got absorbed into this IPOs. So the interesting data is, if you look at the this IPOs, majority of these IPOs, 50% of the issuance was typically from the small cap, and particularly in capital goods, NBFC space, healthcare, and technology linked sectors. But if you look at the performance of these IPOs, one data which suggests that almost 40% of the recent IPOs, they were trading below their issue price within just 1 month of listing. So clearly, most of these IPOs, they didn't deliver a good return. On a median return basis, also, if you look at 2025, they delivered just 3 to 4% kind of return. So clearly, IPO market, didn't do so well after the listing, and it kind of disappointed. But obviously, it sucked a lot of liquidity from the DI's flows. Now, if you look at from an inflation perspective, India's CPI inflation has been trading. It's been below the target level of almost 6%, and we are in a comfortable zone. So we can say that it's a more wait and watch stance which now RBI wants to take, and at this point of time, a further rate cut is something which there could be a wait and watch kind of scenario. So keeping this in mind, I think inflation is in a very, very comfortable position, and we have seen prolonged food price deflation. And if you look at the core inflation also, it has been coming down. So keeping this in mind, I think the further rate cut is not expected in the immediate shorter term, and that's where the inflation situation is. But if you look at the situation of the rupee dollar, or USD INR situation, we have seen some sharp correction. So almost 8% kind of drop has been seen in USD INR. So obviously it is because there's a huge amount of trade deficit, and a lot of volatile capital flows have kept the lot of pressure on the rupee INR, USD INR situation. But in the current context, from a FII perspective, it looks like that they have seen almost 8 to 9% kind of depreciation in the rupee, and it makes very attractive opportunity for FIs to turn back to Indian market, because at this level, if they enter into our market and rupee starts to stabilize at current levels, then it could be a good entry point from a FI entry perspective. And if you look at FI holding in our market, that has also come down to a level seen in the last 1 decade, close to 15.5, 16% kind of holding. And there we believe that this holding used to be 20 to 23%. So there's already a huge amount of a reduction which we have seen in FI holding, and now 15-16%. But can see here a lot of buying interest can start emerge, because obviously we have seen rupee also depreciating close to 8 to 9% in this last 1 year. In the context of global GDP growth and inflation outlook, we, at this point of time, what is important is that these are the three important things to watch out. One, deglobalization, which is going to be a very big trend, and that's the reason now everyone is talking about, tariffs, and a lot of, see, China has imposed restrictions on silver's exports. Almost 110 million ounces of silver has been restricted to other countries. There is a concern regarding rare earth magnets. So all this is clearly indicating that deglobalization is a theme which is gaining a lot of strength. But the debt levels have been rising across the globe, and if you look at the world market, there is a challenge regards to the adverse demographics. So all these the three things are actually limiting the long term or the medium term growth potential of the global economy. And that's where, when we see the GDP growth of the world, it has been in a very I would say, muted shape. Keeping this in mind, developed markets are particularly affected at this point of time due to aging population, very high leverage, which is kind of creating lot of concerns for growth on the developed economy. But if you look at from the emerging economics perspective, there is a lot of policy flexibility which is happening, and that's where we think that a lot of shift can happen in terms of growth towards emerging economies. Now, if you look at tariff-related disruptions is going to persist to 2026, and although we don't believe the incremental shocks to be bigger, but definitely it is going to we are going to see some kind of consolidation, and the after effects of previous trade actions can see some concerns. So at this point of time, I would say that the world economy is in a kind of disordered manner, and there can be some kind of volatility both from tariff related issues and the huge commodity inflation which can start emerging due to rising commodity prices, not just the precious metals like gold and silver, but also commodities like copper, aluminium, zinc. Everything is going up. So this is also going to create some kind of uncertainty at a global level. Now, what is interesting is the kind of fiscal support a lot of these developed economies are doing. So if you look at Germany, Japan, and US, they have put together almost spent 1.2% of their combined GDP in terms of the fiscal stimulus. So now the challenge is, if you are going to provide a fiscal stimulus to support or to kind of solve the structural weaknesses, it might help us in the shorter term, but in the long term it poses a very material risk. And that's the reason we believe that there is going to be an environment where the borrowing costs are going to rise. It may compel central banks to eventually engage in the quantitative easing, and to preserve to kind of do the quantitative easing. But at this point of time, we can say that the global world order is not in a great shape. There's going to be a lot of fiscal stimulus, and which might indicate that further quantitative easing can be seen in the global markets. At this point of time, these are the major events which we are dealing with. So obviously, Venezuela, we have already seen the regime change, and the impact of it could be on oil. So if you look at, Venezuela almost has got almost 300 billion barrels of oil reserves with them. But at this point of time, the out of the global production, it contributes only 1%. So it will take a lot of time for this reserves to come into the real production. So we believe that in the medium term, we are not going to see a significant drop into the oil prices. But yes, structurally, it looks like oil prices are capped in the longer term. So definitely the trajectory of oil from a longer term looks like it is going to be on the downward trajectory. But yes, in the short to medium term, we don't see immediate impact of this Venezuela oil supply to come to the world, and that's where I think the oil prices are going to remain stable. US tariff and trade tensions, so we are already struggling with 50% tariff, and it is also affecting some of the sectors like textiles, apparels, and gems and jewelry. And this has also resulted into a 13-month high trade deficit in the month of September. And we are also, seeing a lot of foreign investor outflows, which is happening due to these concerns. And now there are talks of, this escalating further. So I think that's that is the uncertainty which we are at this point of time facing. And this is the reason why Nifty has hit a fresh all-time high 4-5 days back. But now we have seen a good, selling or cool off in the last 4-5 trading sessions because of this heightened volatility which is happening due to the expected elevated tariff rates. Now again, if you look at one very interesting thing which we need to watch very closely is Japan's rising bond yields. So here there's a speculation that the Bank of Japan might tighten and might increase the interest rate. And if that happens, then we are going to a reversal in the yen carry trade. And if that is the case, then we might see some serious liquidation happening across the globe, because Japan was the cheap source of funding for a lot of global investors, and the currency was very stable. Now, since there is a lot of volatility in the currency, and if interest rate starts to go up in Japan, then definitely the yen carry trade could become a very big risk going forward. So that is one very important event we are tracking very closely at this point of time. Here in India, if you look at the GSEC yields, so the GSEC yields are still hovering around 6.5 levels, whereas if you look at the the repo rate, it is close to 5.25. So there is a gap of almost 135 basis point between the GSEC yield and the repo rate. If you look at the start of the beginning of the year, this gap was hardly 30 to 40 basis point, but now it has widened to 135 basis point, clearly indicating that although RBI has been consistently reducing the repo rate, but the bond market is still not anticipating that the inflation is going to come down, or it is anticipating that the inflation might go up. And because of that, we are seeing a sustained kind of upside in the GSEC yield. And so that's a gap which is there. And it is not just India. If you look at the 30-year bond yields for different countries, whether it's France, UK, Japan, Germany, or US, everywhere, despite interest rates coming down, we are seeing the bond yields are continuously on an upward trajectory. So now going forward, financial year 26 market projection, very interesting data is this earning downgrades to growth normalization. So if you look at when the year began with for financial year 26, the EPS estimate was close to 1300 rupees, but this EPS estimate has come down from 1300 rupees to below 1200. So there is almost a 10% drop in the earning estimate for financial year 26. If you look at the previous years, obviously from COVID period, then this upgrade downgrade cycle, clearly this number used to be here and there of 2% plus minus. But in 26, we have seen this number, this downgrade happening almost 10%. And that's the reason we have seen a very muted performance coming in financial year 26, because the earning estimates have come down significantly. Going forward, since the base has come down, financial year 27 estimated EPS is going to grow at 17%. And if you look at financial year 28, this number is expected to grow at 14%. So we believe that after the base coming down, financial year 27 and 28 can see a double digit earning growth. And that's where a lot of positive hopes, which is coming from India market. And obviously the reasons we know, and we are going to discuss why there could be a re-rating in the EPS or the earning estimates for a lot of these companies. But at this point of time, first we would like to discuss about the valuation parameter. So if you look at Nifty 50 currently on a 27 estimated EPS is trading around 21 forward PE multiple. And if you look at the 10-year average PE multiple, on a 1 year forward basis used to trade at 21 times. So we can say that the large cap is trading at a very fair valuation. And that's the reason in this 1 year period, we have seen Nifty delivering positive double digit return close to 10%. Whereas in case of small cap, we have seen small caps delivering negative 6 to 7% kind of return. The reason is very simple. If you see BSE 250 small cap, it is currently trading at a 24 times PE multiple on a 1 year forward basis, whereas the 10-year average used to be in the range of 17 times. So we can see still the PE multiple of small caps are at significant premium to its 5-year, to its 10-year averages. And the earning on the earning side, there we have seen some disappointment, and this has resulted into a huge selling pressure coming into small cap indices. Although from a absolute level, it looks like 6-7% correction, which has happened in the small and mid cap. But at a broader level, we have seen the correction to be very, very meaningful. And we have created one data, which we will share it with you. Yeah. So here I would like to give this data, which suggests that what is the kind of downside our markets have witnessed in this last 1 year. So if you look at NSE 500, only 38% of stocks have actually outperformed NSE 500. Whereas if you look at out of the actively traded stocks of almost 2,536, 1548 stocks actually ended in the red. And just 529 stocks have actually outperformed the Nifty 50, which suggests that just 20% stocks have actually beaten the index, and 80% of stocks have actually underperformed the Nifty. But if you look at the magnitude or the intensity of the fall, you can see that more than 145 stocks are down more than 50% in this last 1 year data, whereas 864 stocks were down in the range between 20 to 50%. And almost 539 stocks were down anywhere between 0 to 20%. So what we can observe is maybe the index is indicating a fall of 6-7% on the BSE 500, but at a broader level, there was the depth was very bad, and the index showed a very resilient move. So clearly, this is a market where I think a lot of selling has happened at a broader level. Now, coming to JM's Apex PMS strategy, we can say that it's a fusion investing, as Akshay has rightly mentioned, and it's a combination of fundamentals, technicals, market dynamics, and psychology. So we try to create a portfolio which is a blend of fundamentally sound companies. But when we identify these fundamentally sound companies across market cap, because we call it as a flexi cap strategy, where we try to take positions not just in the large cap, but onto mid cap, small cap, and even micro caps to a certain extent. So it's a combination of different market caps. Once we identify different stocks from different market cap, then we try to do a lot of technical and quant analysis into these stocks, about the sector rotation, whether the shift is happening from growth to value or vice versa. Is there a lot of buying interest which is there in the PSU bank versus private bank, or vice versa? Is auto going to do good on a 3 year basis, because they have underperformed for last 6-7 years? So those kind of a lot of quantitative analysis is which we try to do in our technical parameter. Once we are done with the fundamental and technical part, we also try to understand what is on the behavioral side, or you can say how is the market dynamics position at this point of time, and how is the broader psychology which is taking place. Because ultimately we want to understand that if market is not willing to reward a particular sector at this point of time, even if the fundamentals are good, as we have seen in the past also, market may remain irrational longer than one may remain solvent. And just to give you a case study, we have seen this in PSU banks, we have seen in this in public sector undertakings from 2007-8 to almost 2022-23 period. Almost 12, 13, 14 years of underperformance we have observed in these sectors. And once this underperformance started to catch up, these sectors delivered almost a very significant return in a very short span of time. But this 13-year period, even if these companies were doing good, market was not willing to reward them. So it's important to position ourselves according to how the market dynamics are changing, how is the greed and fear cycle playing out, what is the market sentiment. So for example, defense as a space, it got rewarded post Russia-Ukraine war. So it doesn't mean that 2014, since 2014, government was doing a lot of work on indigenization, reforms on the defense side, but the price performance started happening post Russia-Ukraine war, when market realized that it's very important for a country to be self-dependent. Indigenization is an important thing, and that's how the PE multiple got re-rated. So the entire defense, which used to trade at a PE multiple of 10, 12, 13, 14, 15 times, now they are trading at 40, 45 times kind of forward PE multiple also, because the perceptions has changed, and this perception is nothing but the change in market dynamics and psychology, which we are talking about. We look into Peter Lynch for a lot of this style of investing also to a great extent. So just to give you a data, Peter Lynch, who was the fund manager with Magellan fund at Fidelity, and during his 13-year tenure, this fund has delivered a very significant alpha to the broader market. But the interesting thing is that Peter Lynch in this 13 years of his journey has bought and sold almost 14,000 stocks, which suggests that his average holding period was just 6 months. So it means that what he was tracking very closely was just one piece of data, which was the earning growth momentum. So if the earning growth is there, then he used to ride the trend, and whenever this earning growth starts to see a deceleration, even if these companies are high quality companies, they may face periods of consolidation or underperformance, and that's how a lot of this switch used to take place. And that's the reason in his 13-year period, this fund has seen a churn, and but despite this high churn, he generated very significant alpha against the broader market. So at this point of time, we can say that where the opportunities and challenges lie. So obviously the biggest challenge is the geopolitical uncertainty at this point of time. So this geopolitical uncertainty in terms of tariff, in terms of wars, in terms of the commodity prices going up, and access to these commodities, restrictions, all this is going to create a lot of uncertainties. And during these uncertainties, where the opportunity lie is the domestic demand, and that's where the government has focused in last 1 year. In this last 1 year, we have seen significant shift in government's thought process towards spending, towards consumption. This got reflected into GST reforms. This got reflected into what has happened on the income tax relief which the government has provided. and this is going to support low income, middle income level group to a great extent, and at the same time to provide liquidity into the banking system. So all put together, almost 4.5, 5 lakh crore kind of liquidity has been infused into the system so that domestic consumption starts happening. And if there is any uncertainty with regards to geopolitical concerns, to a great extent, this consumption cycle can kind of give us a kind of relief in this uncertain environment. The second biggest risk is the US tariff impact. So I would say we can say that's a binary thing where either the US tariff will remain at an elevated level, or this deal goes through, and that's where the biggest risk lies. And that's the reason one has to be very selective in terms of sector selection, in terms of stock selection, because at this point of time, lot of these global exposure related stocks might face uncertainty, and that's the reason a lot of these sectors are facing continuous derating in the PE multiple. The earning growth is disappointing. IT, we have seen that the mid cap IT might grow at 1.5-2% on in terms of constant currency QOQ, but the larger ones, they are growing in the range of 0.5 to 1%. So we are not going to see significant change in the earning growth momentum of these IT companies, and that's why exposure to IT sector at this point of time should be limited. Same is the case with textile, gems, and jewelry, and even to a great extent, chemical companies or specialty chemical companies, which has got very high exposure in the global market. So these kind of sectors one should avoid, and focus should be more on the domestic consumption. As we already mentioned, rupee has weakened to the tune of almost 8% in this year. But if you look at from a FII perspective, and if rupee starts to stabilize at current levels, then it gives them a very good edge, because suppose if they would have exited at 83, 84 level, for them to enter at these levels, their entry level becomes very, very attractive. So this is the reason we believe there is a possibility, if rupee starts to stabilize and interest rate starts to come down in US, we might see some kind of shift coming to India market. And there is already a talk going around, a shift from AI. And if that happens, then India is a natural hedge against this. If there's a shift from AI investing to other markets, then India becomes very, very attractive, because we are not great in terms of AI or innovation. So that's the reason we have also underperformed. But going forward, if there is a selling in the Magnificent Seven of US, then we might see some buying interest coming into Indian market. Now coming to the valuation, so we have already said that Nifty large cap is trading at a fair value of 21 times forward PE multiple. A small cap is at a higher valuation, and mid cap is, we can say, almost in line with what it used to trade on a 5-year, 10-year averages. But where the biggest surprise can come is the turnaround in the earnings growth. And as we have indicated that both 27 and 28, we can expect double-digit earning growth. So this can lead to re-rating, and even at a higher valuation, market might see buying interest. Plus, on a relative basis, we have seen that global market, world market, and emerging market, this premium has corrected. So the emerging market premium, which used to be 100, is now 65%. So it makes us attractive at this point of time. From a policy shift perspective, obviously we have seen the CRR cut from 4% to 3%, which has released almost 2.5 lakh crore liquidity into the system. This is also going to support the overall credit growth, and the consumption. And that's the reason we believe that banking, NBFC as a space looks very, very promising at this juncture. First, because if you look at the overall credit growth environment, it used to be in the range of 8 to 9%. And now this is shifting from 8 to 9% to almost 13 to 14% kind of credit growth. We have witnessed very recently a lot of PSU banks, they have delivered 13-14% kind of loan growth. Axis Bank has delivered almost 13-14% kind of loan growth. So keeping this in mind, I think the credit growth environment is improving, because interest rates have started coming down, and there is a boost towards consumption. So if the consumption improves, obviously the private capex will start coming, which was the missing case. We have seen this last 2020 till 2024-25 5 year, it was more of government spending, government doing a lot of capex on in railways, in defense, in the form of PLI schemes. But private capex to a great extent was missing, and now because consumption is going to get a boost, we might see private capex coming in. And if private capex improves, then the overall credit growth environment is going to change, which can be very supportive for banking and NBFC as a space. And if you look at from a valuation perspective also, private banks at this point of time is trading at 2.2 times price to book on a forward basis. So which is comfortably far lesser than its 3-year, 5-year and 10-year averages. So it makes valuation very attractive at this point of time for the entire private banking basket. Same is the case with PSU banks. So the credit growth environment is very positive for the PSU banks. And from the operational parameters, a lot of these PSU banks are delivering in line to their private peers. But from a valuation perspective, a lot of these PSU banks are trading at a significant discount to the private peers. So there is a possibility we might see further re-rating into PSU banking basket, and that's where the entire banking looks quite promising at this juncture. Uh, we have already discussed about election linked. There is a election linked state schemes which is towards welfare spending, and government has already spent close to 68,000 crore on welfare schemes ahead of polls. So in the case of Maharashtra, we have seen Maji Ladli Ben Yojana, where government has put in almost 23,000 crores. In Bihar, they've spent close to 19,000 crores. And there are 5 major state elections which are going to take place in 2026 in Assam, Kerala, Tamil Nadu, West Bengal, and Puducherry. And this is expected to further drive this, social spending. So, keeping this in mind, we believe that the overall consumption can improve because money will come in the hands of consumers, and that's where the discretionary spending is going to take place. Where we are going to miss, so I think there's going to be a miss on the capex execution target. So as we can see, the original budget estimate was close to 11.11 lakh crore, but which was later revised downwards towards 10.18 lakh crore. So clearly we believe that the capex intensity is going to come down. Maybe not in all the sectors, but yes, definitely there is going to be a deceleration which we expect. The outlier could be the defense as a basket, because the kind of heightened uncertainty which we are witnessing globally, we might see a push on the defense spending, but other sectors might see some kind of reduction in the capital outlay. Um, a very interesting chart, because a lot of investors, or we are discussing about these commodities on a day-to-day basis. So this is just a data which suggests that on a 1-year basis, if you look at silver has outperformed its counterparts, whether it's gold, copper, aluminium, or zinc. Silver has been a clear outperformer, which has delivered almost a 343% return from the bottom. Gold has delivered almost 181% return from the bottom. And now we are seeing a good trend emerging in copper and aluminium. So we can say that there's a shift which is happening, which could happen from precious metals to now the base metals, because of the industrial usage which copper and aluminium has. So we expect positive trend to emerge in both of these commodities. This is just a small data point of copper, which suggests that copper has been into a consolidation phase for last 19 years. And the last cycle when copper saw a big rally, it was between 2003 to 2006. Post then, it has been consolidating. And after this consolidation, finally in 2025, we saw a decisive breakout coming into copper. And this is due to 3 important factors. We are seeing copper's demand accelerating for EVs, for for the AI, for the renewable energy as a space, and all this is going to see in a very increased copper demand. So the refined demand is expected to cross 37 million tons by 2035, and and if you look at this data, clearly there is going to be a deficit of 4 million ton by 2035. If you look at the mine's capacity, it is coming down, the ore quality is deteriorating. So all this is going to create a structural deficit for copper. And in the last 20-30 years, we have seen chronic underinvestment in the entire commodities, and this is also going to create huge supply demand mismatch, and that's where we are seeing some serious buying interest coming into some of these commodities, and that's the reason copper has given a breakout after 19 years of consolidation. Gold, we can say positively, it has actually impacted Indian households because India holds close to 25,000 tons of household gold, and in last 25 years we have imported close to 17,000 tons of gold. And because of these, we can say that gold prices going up, every 1,000 rupee jump in gold prices, it actually adds 1 lakh rupee, 1 lakh, to the household wealth. And that's where we believe that Indian households have seen a good wealth impact because of this rising gold prices. This gets reflected into the gold loan. So we have seen almost 64% jump in the gold loan growth, which has tripled to almost 3 lakh crore. And this is obviously because the higher income households, which typically means that income level beyond 50 lakhs, it has seen almost 3 times increase in the gold loans. And we have placed close to 1,700 tons of gold. So if there's going to be a slight change or rise in this pledge level, then this gold loans can go from 3 lakh crore to almost 6 lakh crore. So we can expect the gold loan to go up significantly, and that's the reason the entire gold financing companies are seeing a very, very strong uptrend, which has been observed in the last 6 to 9 months time frame. Coming here, so if you look at consumption, discretionary, and auto, this is going to be a biggest theme for 2026. The reason, obviously, GST rationalization we have seen from 12 to 5%, and the 28% GST becoming 18%, and the income tax savings, which is going to add almost 6 to 10% of the household budget. This is a direct liquidity stimulus, which is going to as we have mentioned, 4 to 5 lakh crore kind of liquidity into the system. Plus, the rural economy is going to see a good jump, obviously, because this time the monsoon is above 7% above normal monsoon, and we have already seen the repo rates coming down, plus state election push is there. So all put together, we believe the auto affordability is going to go up significantly. The financing conditions are going to improve because the interest rates are going to come down, and this is going to positively impact passenger vehicle, two-wheelers, four-wheelers, tractors, and the auto ancillaries. And this data also suggests that in 26, 27, 28, we are going to see good amount of growth in the auto numbers. Same is the case with credit growth, which was in the range of 10-11%. It is going to go to 13 to 14% kind of credit growth. Again, very positive for the banking sector. And as we have already mentioned, banks are trading at a very comfortable valuation. As we can see, the overall is trading at 1.6 times, obviously, because it is both private and PSU banks. So at a blended level also, if you look at it, is trading near its long-term averages, and there is a scope for this price to book to go up further. The loan growth has already bottomed out, so we might see good recovery, and there is a good recovery in the NIMs. The net interest margins are improving, which will again positively add to the return on assets for these banks. And the return on assets improves, obviously the ROE profile of these banks will improve. This will lead to re-rating into the multiples. So yeah, this is one data which suggests how the metal sector is doing, because that's where the buzz is. So we have also tried to given a data which tells how is the Nifty metal doing against CNX 500, which we call as a ratio chart. So if you look at the ratio chart, after a long consolidation, the Nifty metal is coming out of a consolidation phase, which indicates that in days to come, in months to come, we might see metal as a sector can give a good outperformance against the CNX 500, and that's where a lot of these commodities, copper, aluminium, iron ore, or steel companies, we should keep on watch, because it could be a good cyclical recovery, but the data clearly suggests that there can be a good outperformance which will emerge from metal as a basket. Consumption, as we have already indicated, there's going to be a big positive for consumption, but this is also getting reflected into the price behavioral side. So the downside of the bottom suggests consumption against CNX 500, and it clearly suggests that there is a higher bottom, higher top, higher bottom structure which is getting formed on consumption versus CNX 500, and it suggests that at this point of time, if this higher top, higher bottom sustains, then we are reaching near the bottom for this chart. So there can be a good recovery which will start happening, and if that happens, then clearly consumption is going to outperform the BSC 500 or CNX 500 or the broader markets, and that's the reason the entire consumption basket we should keep in radar. What we don't mean is that obviously within consumption comes FMCG, within consumption comes consumer durables, even the electronic manufacturing service as a space is a part of consumption story, or the new age companies, which includes names like Zomato or Eternal, Swiggy, Cartrade, a lot of these companies. So we believe that these are all part of the consumption story, and it looks like consumption is at a very important support point from a price behavior perspective, and there is a possibility of outperformance coming from consumption. Banking, we have already indicated, looks very interesting, and this can get reflected. There is a breakout on Bank Nifty versus CNX 500 chart, so which suggests that banking as a space is going to outperform the broader market in coming months, and this is getting reflected both on the absolute price behavior of banking as a space, as well as Bank Nifty versus CNX 500 ratio chart is clearly indicating the same. And since consumption is going to do well, auto is the biggest discretionary spending which can happen, and it is getting reflected into the price behavior. So as we have said, we try to combine fundamentals with technicals, market dynamics, and psychology, and this is where how we try to combine the fundamentals of these space or sectors with what is happening on reality in the market, and this is the outperformance which auto as a basket is showing against the broader market. Yeah, so one more last data point I want to suggest is about silver. So after a very stellar up move which we have seen in silver, just wanted to highlight few data points. In 1981, when the Hunt brothers took a bet on silver, we have seen silver almost delivering 5.5 times return in a short span of 3 years time frame. And after this significant outperformance, it corrected close to 80%. And after this correction, it stayed there for a very, very long time. And it took almost 30 years for silver to cross that previous high of 1981. In 2011, again, it moved almost 4 times. And this time also, after advancing 4 times, it corrected 70% from the top. And then it took almost 14-15 years for silver to cross that 2011 high. Now, this time it has reached, we have seen almost 300% kind of return from the lows, and obviously lesser than what we have seen in 1981 or 2011. So there is a further scope for prices to go up. But this time there is one big change. The industrial usage of silver is going up significantly. We use almost 70% of silver production into the industrial side. And with this AI, data centers, renewable energy, or the EVs, the usage of silver is increasing significantly. So let's give a very small example. In an IC, let's say if the silver usage is 0.25 grams in per vehicle, the same silver can be used to the extent of 70-75 grams in a EV vehicle. So almost significant jump can be seen in terms of actual usage of silver, and that's where there is a real demand. But the point is, after this stellar up move of 300, 400%, which we have observed in the last 2-3 years time frame, it is time for right risk management. So we believe that at this point of time, fresh entry, it's very difficult to comment, but definitely risk management should be there, because we have seen silver has been a notorious asset class in 1981 and 2011. So ideally, there should be right risk management in place. Thank you.
Thank you. Thanks a lot, sir. I think that's very, very detailed PPT. The PPT had, how 2025 was. It's like a reconciliation of how 2025 and what an investor can expect of 2026. With that, it put me into a situation where I have very less time to ask questions. But never mind. I will take something which was not taken in your PPT, which is Apex. Apex, the strategy was not, much covered, though you covered about macros from US and from Venezuela, oil issues, everything. But as an Apex strategy, apart from, the PSUs, banking and consumption, which you just mentioned, apart from, what are the other sectors that as Apex has given high weightage on? I'm just directly jumping into the strategies.
Yeah, so definitely we have indicated that sectors which looks very promising to us with it in the consumption, banking, auto as a basket, and we can say that there can be a tactical bet even in the metal space, metal sector, because we are observing this kind of de-dollarization as is a very big trend, and the way under capacities has been created on the entire commodities, this could be a tactical bet. Apart from that, we believe that the entire CDMO opportunity within the pharma looks very, very interesting, because if you look at the pharma as an industry might be growing at 7-8%, but if you look at the CDMO or the CRDMO space, it might grow at 14-15% kind of growth rate in terms of top line, whereas in terms of profitability or EBITDA growth terms, we might grow beyond 20%. And that's where we believe that the structural tailwind is happening in this CDMO opportunity. So that looks very promising within the entire pharma basket. Apart from that, in the bank, we call it as capital market as a theme. We are very, very positive on the entire capital market theme. Just to give you a small data point, at this point of time, the assets under management for entire AMC could be close to 75 lakh crore. Out of that, 42 would be 42 lakh crore would be in the equity, and rest would be in debt. But we believe this number can go to 300 lakh crore. So if that is the case, we see very structural tailwind for the wealth managers, for the asset management companies, and even brokers who are transitioning themselves from the traditional broking to an annuity income kind of thing. So here we believe that the structural tailwind will lie, and certain platforms within the capital market things like exchanges could be a big beneficiary. So we are seeing what is happening to gold, silver, copper, aluminium. Now, obviously, what could be the indirect play? The indirect play could be a good platform where a lot of these commodities will get traded. So I think those kind of exchanges will be a big beneficiary of this mega trend which is emerging due to financialization of savings.
Okay. And also, one follow-up question is that, within flexi-cap or multi-cap, what kind of a percentage would you allocate to large, mid, and small? And how is your cash allocations? How do you see this 2026, and how are you positioning your portfolio in that?
So see, we have seen time and again, taking a cash call. Once someone allocates us capital, the intent is that we should invest into equities or into asset classes. Maybe if there are certain ETFs available for different commodities, even some exposure can be given to those as a tactical bets. But the point is, this has come to us for putting as allocation, and that's where we are not a very big believer of creating too much cash in the portfolio. Tactically 5-7% here and there, obviously we try to create in an uncertain time. It might go to 12-15% in an extreme environment like what has happened during COVID period. But typically we always remain invested in the market. And in terms of, since it's a flexi cap strategy, but the idea is to have anywhere between 40-60% at all point of time into a large cap. And Depending on the same, we also try to allocate 40 to 60% to a small mid cap. There is a reasonably small allocation to even micro caps, because that's where some emerging opportunities emerges. But then we try to restrict ourselves to a number, a single high digit number, a single digit number, but not 12 15%. So somewhere between 7 to 8% is a typical allocation we also try to do into a micro cap. So you can say it's a mix of large cap, mid cap, small cap, micro cap, all put together. And that's the reason we call it as a little diversified across market caps.
Yeah, I think that is well diversified portfolio. And one thing, when you were talking about in your PPT regarding the macros and how the global market and how the deglobalization, like how India has been a little less correlated with US markets. But from an investor standpoint, yeah, we have retail investors being very strong, very stable, and on they're pulling up the market, which is DIIs are pulling up the market, but FII are being quite restrictive in this thing. So from a fund manager point of view, what would you measure in a higher position? Like, is it DIIs coming in, or the FI is moving out? Which should be taken in at the first?
So Akshara, see, definitely we always try to focus on what smart investors and institutional investors are doing. But at this point of time, there are different reasons for FI to take an exit. One, obviously, rupee has been on a sliding path. So we have seen rupee depreciating almost 8%. In their home market, they are seeing very good growth, maybe because of AI, maybe because there is a lot of focus on this new innovation, and that's where the growth was happening in their own market. So this is also kind of creating liquidity, their liquidation across market and trying to shift into their own market. If we look into the performance of emerging market, obviously it is also more to do with what China has delivered on a 1 year basis. But if you look at the performance of China on a 3 year, 5 year, 10 year basis, China is actually underperformed except last 1 year. So keeping all this in mind, I think if we confuse ourselves at this point of time what FIs are doing, then we would have missed the rally in 2023. We would have missed the rally in 2024. Yes, 2025 was a pain period, but we need to understand, even after this underperformance, portfolios across the board have been doing double digit kind of returns in this 3 year, 4 year, 5 year period. And this is the reason we believe that 1 year underperformance should not lead to kind of inferencing that since retail participation is going up, there should be worry. But yes, one thing is for sure, 2026, obviously because of the geopolitical uncertainty and global uncertainty, one need to be very stock specific, sector specific, and it is not going to be a broad based market recovery. So we need to track the earning growth momentum very, very closely.
And talk about your performance when you just mentioned about performance. If you could take in what was the since inception performance of Apex and how has it performed?
So if you look at since inception, we started in 23 February, and I think since then this portfolio has delivered close to 18.60% kind of return on a CAGR basis. And if you look at so on a 2 year basis also, it is almost in line with what BSE 500 has delivered to the tune of 11%. Obviously, we have seen the small cap, micro cap have seen big amount of correction, but despite that, if you look at on a 2 year basis, it is in line with index. And on a since inception also, this portfolio has delivered almost 18.6% CAGR return.
And from 2025, what happened was like people, investors were pulling out money from equity, but they were pushing into debt. That the allocation towards debt were comparatively more in 2025. But the 60-40 rule or 80-20 rule doesn't work in every other scenario. It doesn't. So for 2026, what would be the ideal allocation for an investor to look into equity, debt, and other assets?
See, from a valuation perspective, we can say that India is at a very fair value. But from a earning growth perspective, as I already mentioned, 27, 28, there's the expectation earning growth is going to be in double digit. Keeping this in mind, and we have already underperformed the global peer in the last 1 year. So there is a good possibility we might end up in a positive shape. And that's where I think the equity allocation should start happening. But obviously, it also depends on the age, on the income level, on the risk appetite, whether you are a conservative, aggressive investor. Depending on these factors, actually the right allocation between equity debt should be looked into. But definitely from an equity perspective, I think after 1 year of underperformance and the kind of sell-off which we have witnessed in the small and mid cap, and as already indicated from a breadth perspective, we have seen many stocks correcting in the range of 30 to 50%. It is a very attractive time to start looking into equity markets.
So without any biases, like 80% to equity.
So if you ask me, yes, but definitely for asset allocation, ideally, it depends on the age, it depends on the risk appetite. But yes, since we are firm believer into equity, so for me, it would be 80-20.
Fine. So I'm not taking it as a bias thing, but still, that's a recommendation from a equity fund manager. So we can bring it like that. And at this standpoint, when an investor steps into the market currently, what he can expect? He cannot expect the returns of the investor who have joined 3-4 years before. So at this point of time, what kind of expectations should an investor should have in terms of returns that he could get?
So first of all, we need to understand how's the nominal GDP going to take place. What's the inflation at this point of time? So we are already seeing inflation trajectory in a downward swing. So you can't expect the same amount of risk premium to this in the current year. So keeping this in mind, I think there should be a risk premium, and keeping this in mind, ideally anywhere between 12 to 15% should be a reasonable ask, rather than expecting what markets have delivered in the last 3 year, 5 year, where the returns used to be in the range of 18, 20, 22% kind of returns. So I think that kind of normalization in terms of return expectation should be there from an investor perspective.
So at least 1-2% above the inflation is what the fair expectations would be.
Yeah.
And also, because we've already passed the timeline, but it would be unfair if I don't ask this question. We just got to know about the FTM framework, which combines the fundamental, technical, psychology, everything of it. But what is the exit? If Apex had an exit strategy, if the stock should come out of the portfolio, what would trigger that particular sale?
So definitely we try to combine both the fundamentals and technical. So let's say I'll give you a live example.
Yeah.
Let's take this example of EMS as a space. So the entire electronic manufacturing service as a space is in a great growth shape. So we believe that the industry itself can grow at 30-35% CAGR because of the very strong PLI schemes in place, and a lot of focus on indigenous and manufacturing of the entire electronic component manufacturing ecosystem in India. Now, keeping this in mind, the long-term tailwind is still there. But if you look at in the shorter term, the quarterly results were not great. A lot of these stocks actually disappointed in terms of their earning growth in this quarter. Now, it's a very short term time frame, but the challenge is from a valuation perspective, a lot of these companies were trading at a very high PE multiple. So we try to understand it from the PEG ratio, which suggests that if the PE multiple is at 30 times, what is the growth expectation? If the growth expectation is almost 30%, then the PEG will be 1. And if the growth expectation is 15%, then obviously the PEG would be 2 times. So here despite these stocks going to show a very strong earning growth, the PEG ratio was significantly higher, and this kind of disappointed. So because of this quarterly number, there was a disappointment in terms of earnings growth, and the PE multiples were already at a high level. So in these kind of situation, investors get worried and they start to liquidate, and that's where the technical will come into play and say that okay, there is a disappointment in the earning growth. Maybe the long term looks very interesting, but the shorter term, the earning growth is decelerating, so the PE multiples might come down, and it gave a right exit. And see what happened in the last 6 months. We have seen some very sharp correction happening in some of the good quality EMS companies, and that's how the FTPM approach helps us in taking exit decisions on a timely manner. It doesn't mean that we are not going to re-enter the same stocks, because the fundamentals in the long term looks interesting, and at some point of time technically also it will come to a reasonable level, and the PE multiple will also come to a comfortable zone.
Okay, I think with that, I just want to have to add a disclaimer saying that there's no any stock or sector which is taken in this call is not a recommendation either from PMS Bazaar nor from JM Financials. It's purely for knowledge purpose. And of course, in the urge of, let me complete this webinar, but let me ask one final question about the union budget. The next big event and investors waiting for is the budget. So what are your expectations and what is your outlook on this next budget?
So, Akshara, as we have already mentioned that in the last 1 year, government's focus is towards spending, towards social welfare, and this is getting reflected into what has happened on the GST front, on the income tax front, on the interest rate cut we have already witnessed, and in a lot of these state elections we have seen that almost 19,000 crore was spent in Bihar. Then there was a spending in Maharashtra. Another 5 state elections are coming. So we believe that next year also this consumption side of the economy, there's going to be huge boost which is going to come from government, and government also will in this kind of uncertain environment on the geopolitical front, they would like to have the consumption boost because that's where the domestic economy is shielded, and we believe that this is going to be supportive towards the consumption side. On the capex side, we believe that except defense, we don't expect significant capital outlay. So defense as a basket definitely could be an outlier. So if we have to bet on one capex side of investing, then it should be defense sector. So these are the expectations at this point of time. Yeah.
I think that the expectations are very clearly set. So we are, of course, with that, I've come to the end of the webinar, and a lot of praise for your PPT. People are asking, for the PPT and about your fund. Let's take it offline. So I will send you their details and the questions to you. So I will request you to take some time to answer them, and I think that would be great. And wishing you a very happy year ahead. I think with that, I just want to conclude. If you want to say anything to the investors.
Thank you, Akshara. Thank you, everyone, for joining this event and giving us an opportunity. And happy to have a discussion, so you can share your details. Will be very happy to share the performance and the PPT of this Apex presentation. And wish you all a very, very happy New Year. Thank you.
Thank you, sir.